Welcome back to our beginner's guide to stock investing. In part 3, we're diving into the exciting part, making your first trade and what comes next. If you missed parts 1 and 2, where we covered the basics and setting up your brokerage account, I'll link them down below. Ready? Let's get started. Okay, your account is funded and you've done your research. It's time to place your first trade. This is the moment of truth. Log into your brokerage account. You'll need to find the trade or order button. Then, you'll enter the stock's ticker symbol. That's the unique code for the company, like Apple for Apple or Google for Google. Next, you'll choose the order type. For beginners, the two most common are market order and limit order. A market order buys the stock immediately at the best available current price. It's fast and simple. A limit order lets you set a specific price you're willing to pay. For example, if a stock is trading at $10.50, you can set a limit order to buy it only if the price drops to $10 or less. This gives you more control over the price, but means your order might not get filled if the price never hits your target. Then, you decide how many shares you want to buy. If your broker offers fractional shares, you can also just decide how much money you want to invest, say $20, and you'll get a fraction of a share. This is a fantastic way to start small and invest in big-name companies without needing thousands of dollars. Once you've entered the details, review everything carefully, the stock, the amount, the order type, and then hit that submit or place order button. Congratulations, you are now officially a stock market investor. Now that you own a piece of a company, what's next? This brings us to a crucial step. Monitor, but don't panic. It's natural to want to check your portfolio every 5 minutes, especially at first. But the stock market goes up and down every single day, sometimes every single minute. This is called volatility, and it's completely normal. Seeing your investment drop a little can be scary, but reacting emotionally is one of the biggest mistakes new investors make. Panic selling when the market dips often means locking in your losses. Remember, you're investing for the long term. Trust the research you did and give your investments time to grow. It's a marathon, not a sprint. Checking your portfolio once a week or even once a month is often a much healthier approach. This leads perfectly into my next point. Keep learning and improving. The world of investing is vast and constantly evolving. Your first trade is just the beginning of your journey. Dedicate some time each week to learn more. Read books, follow reputable financial news sites, listen to podcasts, and watch educational channels like this one. Learn about different investment strategies, understand economic indicators, and discover new sectors or companies. The more you know, the more confident you'll become in your decisions. Your knowledge is one of the most powerful assets you have. It will help you refine your strategy, identify new opportunities, and navigate market ups and downs with a steady hand. Now, I want to leave you with a few key principles to carry with you. First, start small. You don't need a huge amount of money to begin. Whether it's $50 or $500, just getting started is what counts. Consistency matters far more than the initial size of your investment. Think about setting up automatic, recurring deposits into your investment account. Even a small amount invested regularly can grow into a substantial sum over time, thanks to the power of compounding. This set it and forget it approach also takes the emotion out of investing. Second, if you're ever unsure about picking individual stocks, there's absolutely no shame in that. In fact, a brilliant strategy for beginners is to invest in index funds or ETFs. These funds hold a basket of hundreds or even thousands of stocks, giving you instant diversification. For example, an S&P 500 index fund lets you invest in the 500 largest companies in the US all at once. It's a simple, effective, and lower-risk way to get broad market exposure, and even legendary investors like Warren Buffett recommend it for most people. Finally, and this is important, avoid chasing hot tips or highly speculative trades, especially when you're starting out. You might hear stories about someone making a fortune overnight on a risky stock. For every one of those stories, there are countless others of people who lost everything. Build your foundation with solid, well-researched companies or funds. As you gain more experience and knowledge, you can decide if you want to allocate a very small portion of your portfolio to higher-risk plays. But don't bet your financial future on a gamble. And that's it. You've gone from knowing nothing about stocks to placing your first trade and understanding the principles for long-term success. Investing is a powerful tool for building wealth, and you've taken the most important steps. Thank you so much for joining me for this series. I hope you found it helpful and feel empowered to start your investing journey. If you did, please give this video a thumbs up and don't forget to subscribe for more content on personal finance and investing. Let me know in the comments if you've made your first investment. Thanks for watching, and I'll see you in the next video.